And so, yes, it's a great pleasure to have Professor Weber here. So I'll go ahead and turn things over to him.
Thanks, Vanessa. I can stay here. That's better. Well, how much time do I have? So
if we can try to still have about an hour, that would still work.
I try.
Okay.
Depends how interactive we are. So. So then I can just skip the first one. And so I want to start a bit about general finance approaches that you might know from your, I don't know if you visit the bank or something like that, and also kind of conventional finance and what the principles are there. And then I will talk about sustainable finance after that. So so one big thing, of course, in finance is performance measurement. Everybody wants to know how an investment performs and know how their pension fund performs and so forth. And so if you go to a bank, to an asset manager or something, what do they tell you when they talk about the performance? So end of the year you go and you want to know, okay, what is my RESP doing or whatever? What do they tell you usually then? How much money you made over the year? Yeah. What else?
Maybe how much risk you're willing to take with your investment to get a better return.
Yeah. If they tell you something about the performance or whether you want to know if they're good or not, what do they tell you? Benchmark, right? So so that's information you get. What is the performance? And very important, what they usually do is they do market comparison. So they tell you our fund is 2% better than the competitor. Is that helpful?
Yeah, if you do more than.
So the last 3 years during COVID, things went down. And so they tell you, okay, your fund is 1% better than benchmark. Is that helpful? Somewhat. But what if the benchmark is minus 10%? You're minus 9, and that's not really what you want to hear. But this is often a general principle that is used in finance. It's very much based on benchmarking, comparing performance, and it's less about absolute value. When I want to know what happens with my pension, I want to know when I'm whatever, how old, 65, 70, how much do I get? And I don't care whether I get 1% more than my colleagues at Laurier. If both are around minus 10, I'm rather disappointed. But that's mainly what they do. And if you compare different investors, they compare to each other and they don't compare to an absolute value. And this is something that is very often used in finance. And so you need to know, and I will get back to that when we discuss sustainable finance. And another thing they tell you, it's the development over time. Hey, over the last 20 years, we've made 20% over time. Also that it's fine, but you don't know what happens. Otherwise, if now we have an inflation rate of 6%, so okay, you made 4% this year. Okay, great, it's 2% minus. Yeah. So these are things that are, of course, also kind of marketing, what Jen talked about, but these are these are principles also in academic research in finance that are often used. So the question is it useful? Sometimes it is. The problem is that you as an individual usually want to know what is the absolute income that I create. Now, what is the full value? And this is the same in academic research as well. There's often internal models that calculate whatever the performance of a certain portfolio, the risk and the return and so on. But it's in a way, it just neglects all outside systematic effects. You have COVID, there's a general effect, the down effect that pushes your investments down. That's not really modeled in finance. Nobody cares. They say, yeah, these are kind of random effects that appear from time to time. That's nothing systematic that we have to take into account. It was the same if you think back 2008, those that are old enough. And what happened there? All the great financial people, nobody could predict the crisis. And all of them more or less performed similarly bad during the crisis. There were only very few that didn't do that. And again, you know, because they just ignore outside systematic effect. And what could be a big systematic effect? Climate change, for instance. And so, so this is a general problem. We don't have an external impact, often not absolute values. Doesn't really care, you know, what is the real income that you create? And so if you get these five, this is just a copy of these fun fact sheets, they represent that. If you read what's going on there, you know, it's the same. It's a comparison to the benchmark. It's the development over time, and it's more or less useful information. I'll continue that. So yeah, 2008 crisis. I remember that you went to the bank and they said, you know, wow, your investment is 2% better than the others. Unfortunately, the average loss is 35% or something like that, you know. So that was the response, and like, come on, and the same during COVID. Now you probably have realized that as well. If you go and check, you know, and this always happens if there's some, you know, if there are some crisis. So, but they say, of course, we outperform others. So what does that mean? And this is based on modern portfolio theory. So modern portfolio is not that modern; it's from the 1950s, but at least it's something new. And so, what is the approach there is that you don't need to figure out what are the investments with the best returns, the highest returns, if you have more than one investment. But what you do is you do a risk-adjusted return approach. So you mix different investments in a way that the risk is as small as possible. And you know that you're on mathematics, so you can mix that to optimize the combination. You know? And so sometimes it makes sense, for instance, to mix something into a portfolio that doesn't have the highest performance, but it might be very safe. So you can kind of hedge in times of crisis. We have something in there that you can use. You know, that still keeps the returns up. And so the problem there is what they do is that they diversify. And so so if these different assets are not correlated, you can diversify and you minimize the risks. However, we don't know what the causes of risks are. These are mathematical models. They mix different assets, and then they're optimized. They hope it works. So that's one issue. We don't really know often what are the causes of risks. And then what is totally neglected is the systematic risk. So these are the risks that come to the entire market. So they are not idiosyncratic, and so diversification cannot deal with that. And again, one example could be climate change. So if you have massive impacts of climate change, you know, frequent extreme weather and so far, this affects everything. And so again, you know, they will argue, yeah, our portfolio was great. We were able to optimize things, so your risk-adjusted returns were great. But overall, because of outside systematic effects, it might create minus returns. But it might be better than others, but still, if they don't compare it. And they don't even want to compare that. So in conventional finance portfolio theory, it's not interesting to do that. So if you talk to someone who works in conventional finance, who does research on that, they will say, what are you talking about climate finance? These are kind of effects that pop up from time to time. At the end, they kind of level out. It's random. We don't care. So that's a problem. And this is one of the reasons why we have things like sustainable finance, climate finance, impact finance, and similar things. Was there a question or something?
So is it not something realistic or
Something.
realistic?
Sure, yeah. Of course, we had this systematic, you know, 2008 crisis. So the housing market went down.
But some market was doing okay in 2008.
Yeah, but in general, if you look at general, more of a effect by this external systematic effect. even if you had investments that were not related to the housing market at all, or not to banking at all, but because the general market goes down, we're affected.
I understand, but some markets, if I recall really, it better than others. For example, Canada, it better than the US. The others are more related to have. Energy and so.
Right, that might be, but this is not, that hasn't been modeled before. It was kind of accidental. In a way, of course, some markets do better than others, but it's not part of the investment strategy. Saying, you know, we want to hedge against these kind of things, we do something else instead. So there wasn't, and there might be some exceptions, of course, but the general, you know, investment, you know, the general market went all in the same direction. They went down and some bit better than others, but it didn't help you a lot. If it was -32, but -30.
But what's really the motivation for doing that? Because even though everyone is affected, if the goal is to outperform and you just common sense know that it's not random, there is a trend, then putting that into your model wouldn't be a huge potential for outperformance.
Yeah, so let's say from an applied perspective, from the market perspective, it's competitiveness. So if you want to show that you are better than others, and that's your goal, if you want to sell something, you show that you use the same methods, but you are still better. You know, at the end, when you come at the end, so if there's a pension fund, for instance, they have different investments. End of the year, they have to say how they perform. They always have to say, compare to each other. They say, you know, we are better than the competitor. If they were all -30, it doesn't really matter, because that's how they compare themselves to others. Because they say we can't change climate, so we cannot influence the systematic approach. So we don't care. So that's from the more applied. And then if you go into finance, of course, a lot of that is mathematical modeling and stuff. And there, of course, we want to be in an experimental setting, more or less. So I always say, you know, they fly to space, then they create the models, because there's no impact, you know, in space. So then you come back to Earth, and then you realize, oh, it doesn't work, you know, because there's the reality. So you, of course, try to exclude all other variables academically.
Yeah, so there's no potential for you to outperform because you're treating it as constant.
Right. Okay, so yeah, what does that mean? So external factors are usually ignored, so that they don't care. And so that's a big problem, you know, and that's general conventional finance. And I think we have to change that. And that's one reason why there's sustainable finance and other approaches as well to address this problem. So the question, if you look at corporate finance, so there's a lot of, the question is always, if you're in a corporation, you have to invest in whatever you do, product development, in production, in whatever, in staff. So what do? You think about, if I invest, how much did I have? If I invest $1 million today, what is the outcome in the future? Because, you know, if there's no future outcome, why should I invest it? So that's the main question. So what it means, and you probably know that game, what do you prefer, $500 now? If I give you $500 now, or if I say you get 1,000 in 1 year, what do you take? 500 or 1,000 next year? Who wants to get the 500? Who wants to get the 1,000 next year? Okay. Younger people want to have the 500. But what does that, you know, what does that mean? We have a time value of money. You know, if you get 500 now, if you take the same amount, but if I ask you, 500 now or 500 in 1 year, everybody would say I want 500 now. Because 500 in 1 year are less of value. So if you think about, again, you think about climate change, sustainable development, what does it mean? You discount the future. Or something in the future is less of value than now. So probably you learn what is one of the basic definitions of sustainable development. You heard that, you know, brownlands. So, you know, enabling whatever the current generation to have a good life, plus the future generations as well. But this is totally in contradiction to all basic corporate finance assumptions. Everybody who's in corporate finance says this approach, why should I take into account future generations? It's less value than the current generation, but in sustainable development, it's just the other way. So it's a contradiction.
Is part of the reason why that's the practice in finance is there, people just sort of assume that by maximizing what we are able to do now, we will automatically be better off in the future, like, is that maybe part of what's?
No, the main reason, the reason is, you know, if you invest something now, there's a certain risk. So what you do, you compare it with something that is very safe. So usually you compare an investment with buying government bonds. Oh, you get maybe 3% per year or whatever it is, depends on the time, but it's very safe. So if you invest something in the corporation or anywhere else, you need to get at least 3%. Otherwise, why should you do it? And so this is a kind of a safety mechanism as well. And so what you do is you discount the value of money. And this makes sense probably from an economic rationality, but it doesn't make sense from a sustainable point of view at all. So what they do is they use net present value as the difference between the present value of your cash inflows and the present value of cash outflows over a given period. So I invest 500. What does it mean? I need to get at least 500 back in 10 years or whatever. I don't know what is the approach. Plus the 3% that I get anyway if I just put it on an account.
So I know in finance it makes sense to think about this opportunity cost of capital, right?
Yeah.
But you know, in thinking about these longer problems, you know, it's becoming more common in environmental policy evaluation to consider kind of social time rate of preference. Is how does the finance, corporate finance and table finance think about it?
They don't consider it.
Okay.
You know, if you have a project in a company, even if you say you have a building project, no, you want to invest in whatever, you know, you have something. You see a role will ask you, okay, what is the net present value? And you can say, you know, it's bots, future generation, but it says, yeah. So they would say, no, we can't do that because we have to figure out another way to figure out what we do with our money. We can't invest in something that is lower than the safe income. That would be the argument.
So the government's can.
They can, governments can, right? But it's a problem that we have there. I don't go to the formula, but it's pretty obvious. So you need to create more than the risk-free rate in the future, and that means you are discounting. Okay. That's what that means.
I think just when we step away, I think it's a little bit harder for some of the Zoom participants to hear.
Yeah. Okay. Yeah. So as I said, you know, that's the sustainable development is development that fulfills the needs of the current generation without compromising the needs of future generations. So it's kind of, you know, net present value doesn't really fit to that. The next question, we want to have 0 emissions until 2050. That's a long time. So again, no, we have to they would discount that. You know, kind of conventional finance will discount. It's in 30 years, you know. So, you know, how much do you invest to get something in 30 years? So you have to be a really high return if you want to do that, because otherwise, you know, assume that you get 3% for risk-free rate per year. You have to create a, you know, to make a lot of returns. until 2050, that it makes sense to do that. So these are issues that we see in corporate finance. We have investments are discounted over time, benefit of future generation in a way is discounted, future benefits are also discounted. So this kind of the maybe too frustrating background, but this is kind of conventional finance thinking. And so the question is, do we need something else? And it looks like we think we need something else. So that's good. And so this might be sustainable finance. So what is that? So what does sustainable finance mean? So first, we have on the financial background, we have market-based instrument designed to deliver environmental, so societal quality, transfer, environmental risk. So one example is cap and trade. So that's a market-based financial instrument that might be able to address climate change based on conventional approaches. So that's not too far away from conventional finance, and that's probably something. That's probably why it's relatively attractive. You can convince more, it's a conservative or economy-based people that makes sense because it's a market-based approach. So that's one part of sustainable finance. There's a lot of research on that. Then corporate, the corporate sustainable finance approach, environmental problems from an internal perspective of the firm. So there's always the question, does it make sense to invest in certain green projects and something? Does it make sense if we engage in environmental issues? And what Jane told us as well. So for Audi, they tried, didn't really help. But of course, the reason is because they think if we engage in green, then we can make more money. So that's another part of sustainable finance. And there's tons of research figuring out, okay, if you have higher environmental performance, sustainability performance, does this have a positive effect on your financial performance as well? Are green companies doing better than non-green companies? So that's these are very important questions there. Then the financial industry, they develop products and services that address sustainability issues, such as environment, society. So we have green bonds, for instance, so that there are investments in green products. We have green funds, sustainability, other sustainable financial products. So these are the three main parts in the academic research on sustainable finance. So they address these three topics. And so one important issue there in the financial industry is, if you think about a bank, let's say, what is the environmental impact of the bank? Now, compared to chemical industry or producing concrete or something, is pretty low. It's an office building, more or less. Some commuting and traveling and energy. Now it's increasing a bit because it's more computer power that is used, but in general, it's not really big. And so if you check the CO2 emissions, for instance, a bank has certain CO2 emissions, mainly the building and others. But what is really important is the question, what is the impact, the indirect impact through the business? So a bank can invest in oil companies, or it can invest in green energy companies. That's a simple example. And of course, the indirect emissions, if you invest in non-renewable energy investments, are higher than those in renewable investments. And you can do that for others as well. So companies with a higher, greener performance, where there's others and so forth. So what that means is that the indirect impacts of the financial industry are much higher than the direct impacts. Now, the main thing you should have a look at if you want to measure whether a bank is more sustainable than another is not whether they have the better building, whether they have green lighting. That's fine to have it, but at the end, it's the investments and the loans, the portfolio that counts. So that's very important to take that into account. And of course, this is not trivial, And so maybe you, as the math and modeling people, have a solution how to address it. How can you find solid models that really reflect these things? Because it's not that easy. You have a portfolio of tons of investments. How do you figure out what is the indirect impacts? It's not that easy. So how can we use climate models maybe and connect them to portfolios and then measure what is the impact? I don't know, maybe you have ideas or you want to discuss me, but this is something there's really a need for that. Because it's, as I said, it's not that easy. You know, if you have an investment into a certain company, how much of the emissions do you allocate to the investor? How much do you allocate to the company? How much do you allocate to clients of the company maybe? So it's pretty complex, and there might be ways to connect climate models of its emission models with these with the question. Then the next big question is, what is the connection between the financial industry and sustainability? And a lot of that is focusing on the sustainability as a business case. So does it make business sense to address sustainability, or the environmental society or climate change? And so what they do is, they address risks, in project finance, commercial lending, climate risks. And so the question is, if I give money to a company, how, if I'm a lender, the question is, are there any sustainability effects that might influence the payback of the company? Let's say you give money to tourism, to a hotel that's at the coastline, and you figure out, okay, there's more frequent there was sea level rise or more storms and so far, then maybe they have to close down the hotel because they can't run it anymore, or they have to repair things over and over. And so, of course, that has an impact on your lending because they go bankrupt and you lose the money. And so that's an important thing why banks and lenders and investors consider climate change. Of course, there are opportunities as well, green bonds. So investing in let's say, climate adaptation, climate mitigation, certainly response and investing as well, so certain products there. That's one side. And this, of course, that's a side that most people analyze during academic research. So what's the business case of sustainability? However, there's also a question, and I think that's really important. What is the sustainability case of business? We can turn that stuff around and say, why should the company be allowed to operate if they have a negative impact on society? So why should an oil company be allowed to operate if they emit if they have so many emissions that we get in trouble with regard to our climate? That's a general question, but interestingly, this question is less addressed than the first one, at least in finance and in management research. So how does finance negatively affect sustainability is one question. There's some research now, okay, if I invest in oil versus others, what is the impact of that? But it's also other question that don't pop up immediately. The question, about healthy food, for instance, how much money from the financial industry flows into industrialized food production, big companies? You can wonder, what is the contribution to health at the end? In a way, they are responsible as well. If you invest in companies that produce, well, whatever, a lot of sugary foods, it's not only the company that is responsible, but they get investments and they get money from someone. So you can think about, are they responsible for that as well? Or negative sustainability. And of course, how can finance be used in favor of sustainability? We probably discussed sustainable development goals. We know we need, I don't know how many trillions per year or whatever. There's different numbers floating around, but of course we need some private investors as well if we want to address sustainable development or the SDGs or climate change. It's not only governments, it's not enough money there. So we have to figure out how can they contribute to it, And so again, how do we integrate these different things? How can we integrate, financial models? Does it make sense to invest in something? You have a certain model, and then you model certain societal issues, and are we able to connect that? And this I think it's really interesting to do something like that. And I read a bit outside. I think there were some ideas already. How can you connect these different questions? So let's go a bit more into just explaining what the kind of the history is of sustainable finance, but also what are the different components are. So of course, different components came up at different points in time, but it's not only an historical overview, but it's also, you can see them in parallel as well. You know? And so mainly started in the 1980s, 1990s with credit risk assessment. And the reason for that was a change in environmental regulations. So in Europe and in US, you had the introduction of new environmental regulations, and what they did more or less is they introduced the polluter pays principle. So if you pollute something, you are responsible and you have to figure out how you solve the problem. Interestingly, for us now, especially for younger ones, you think, of course. But no, it wasn't like that in the 1970s. If you had the contamination, we had a company, you contaminated land that nobody directly owned. So what? There was no consequence. The same problem now with the wall fell off. You know, this is a real case in the ocean. So if there's a tanker and there's a leak, there's no responsibility. There's no ownership. You know, nobody owns the ocean. So that still sometimes happens, you know. But this was a big change. And so before, let's say you had a commercial loan to a company, they went default, they went bankrupt, they couldn't pay the loan. And then as a bank, what you do is you sell the land. You have that as a collateral, you sell the land to get some of the money back. So the question was, the problem here was, okay, so the government or whoever, the regulator knew, okay, this is the commercial side. This is on a map with, you know, it's marked as a risk. So if you want to sell that, you either, the first step you have to do before you're even allowed to sell it, if you had to do an impact assessment. You have to figure out, is there any contamination on the land? That costs money, of course. And then if there is a contamination, you have to clean it up, or you have to find someone who buys it contaminated, and probably they won't pay the amount that you thought it is worth before. You know? So for banks, they had financial problems then, because they couldn't realize the value of the site that they used as a collateral. And this was a starting point in a way of sustainable finance, because they had to think about, okay, how do we address that stuff? And they had to come up with ideas, you know, how to assess these risks. And you can do that on a sectoral basis, or you have different indicators that you use. But since that time, this was integrated into the question, you know, what is the risk of a borrower?
I'm not sure what you just mentioned, but was that they started buying oil spill, or why like this?
And yeah, there were kind of big issues, you know, the oil spills, but also small. You know, you had SMEs that produce something, or, you know, you have a small or medium enterprise, you know, producing whatever kind of, you know, a little chemical industry, or they have trucks on the side, and some of them leak oil. So you had that, you know. And of course, it started with cases then when the oil went into the groundwater, and then you had these consequences. But it wasn't only real big events. It was a lot of smaller events as well, because then municipalities or others realized, you know, we have a problem here, you know, because the land was contaminated, you know, or water was contaminated. It was mainly water at the time. So that was the starting point for that. So what you do usually in credit scoring, and that's kind of connection math. So you do a regression model. So you have certain indicators, usually financial indicators, you know, the financial performance of a company, and then you do a regression to default risk, you know, based on cases. So that's a pretty straightforward way to do that, and that's the kind of standard model. And so you have these different financial indicators or management indicators, and then you calculate, you know, you use regressions to calculate the weights, so what is more important or less important. And so what is done is we add sustainability indicators as well. So for instance, what is the industry? You know, is it a high emitting industry, for instance? You know, and does it have a good green performance, environmental performance or not. So these are indicators that you can use to predict the default risk. And so these are general models. And of course, the question can we get better models than just the regressions? Although, we use some logic or whatever that is used, but there might maybe other newer methods that are better, or maybe AI based or whatever. Everybody hopes for that. And how can we raise these different indicators? These are questions that might be solved by by mathematical approaches there. So that's in the credit risk business. So then what we have as next is sustainable products and services. So these are funds, for instance, and green bonds. And I don't know, has anybody of you invested in any kind of a green or socially responsible product or something like that? So yeah, it's getting more and more common to do that. And so it started in the 1990s. There was a kind of a UNEP financial institution association that started the process there to come up with ideas how to deal with the problem. There were environmental management practices that helped as well. In the beginning, if you had an investment in the company, you want to figure out, are they better or worse with regard to the environmental performance? Many of them checked, okay, do they have an environmental management system? And then there were the better ones than the others. So there was something that was used there. So we have green mutual funds, putting together companies or other investments to higher environmental performance. There was even an index, so Dow Jones Sustainability Index. Probably Dow Jones is an index that measures the general, financial market development. And they introduced something that addressed sustainability as well. So they only introduced companies with a high sustainability score. So this was the first ones that is used. And indices are very often used in the financial world to create financial products. So it's very important to know these different index. And then there was an interesting book, if you have time, and try to get a financing change in the middle of the 1990s, what was full of business cases that would solve many sustainability problems. And the interesting thing is, everybody read it at that time. And to be honest, when I read it, I thought, okay, you have solved the problem. There are cases, and every business person will understand that it makes sense. That was the hope, but then, we are now 20, 30 years later. It didn't really fly at the end. It was interesting why. I still don't know why, because there was all convincing stuff in there for insurance companies, for banks, for investors, for other companies. But still, we haven't really changed that much, a little, but it was interesting. And so, and what we do there, as I said in the beginning, if you have an investment. So what we do here, if we have financial product and service, we do a performance comparison. And what you want to know is what is the expected the connection between expected return and the risk of investing in a security in something else. If you have a return of 20%, someone says, oh, you can have a return of 20%, but the risk is 25%. That it might be minus, then you say, no, probably better not. So you need to level the expected return and the risk on the way. And so that's a principle, of course, of investment, so that you address these both things. And what you do here, again, you can have a one-factor model, so you have a certain expected return. And this is the risk-free rate again. So this might be the 3% that you get from the risk account. And then you want to know what's the volatility of an investment, and then you compare it to the general market risk. So that's what is done there. So that's a simple one-factor model that is often used. And you can think about, again, what is the connection to sustainability? What is the connection to climate change? Any other societal issues? Nothing. It's not included,
In the volatility, I always in the volatility taking into account for the
Yeah, it can be, but it's not systematic. So they don't analyze, where it's coming from, the volatility. Is it climate or something like that? So it's somewhat, that's not really accounted for. And then there are other models, it gets clearer here as well. So this is a model that has more or less, I think it's a higher than 95% prediction rate. So if you have earlier data, then you can predict the share price of the company based on that model, and you're pretty good in doing that. If you don't account for systematic changes, you're pretty bad in doing that during the financial crisis. You're probably also pretty bad in doing it during COVID. But if you filter out everything, then you're pretty good. And what they use is, so that's the difference between a small cap portfolio and a large cap portfolio. Because they have some data that large cap portfolio perform with small cap. Then you have the return difference between the value and the growth portfolios. Companies that are more constant and safe versus companies that have a stronger growth. And then you have momentum. That's the difference between the past 12 months winners and past 12 months losers. So relatively short. And if you use that, in general, you have a very high prediction of the share price. But again, you see, these are three indicators that are not related a lot to, systematic changes, to climate change, to societal issues, and so forth. But this is a model that is used in tons of papers. They try to, now there's TCFD, so that's a Task Force for Climate Related Financial Disclosure. That is an association that tries to integrate climate change indicators into the financial industry. What they say is, and you are totally familiar with that, they say we need scenarios. Go to a bank and say, develop scenarios. They don't want to do that because they say, if we do that, we don't know how certain they are. And if we build our strategy on certain scenarios and it doesn't work, the shareholders will come and sue us. So I think, and it might be different in banks, but they rather focus on things that are really certain for them. So they know these are the three. And again, all the other banks use the same. So it's fine. We will use that. We will follow others as well. And so we are not trying to, we won't use any kind of other instruments that create more uncertainty and that we are not really certain that they work. And this is a model that is used for decades, and we have tons of data about that, and they really rather rely on that than coming up with kind of other fancy methods. But I think they are needed.
Could you give a little more information on how this model became established? You use it to predict something and then it actually verify it.
Exactly. So there are different streams of research, and what they do, everybody tries to find empirical, factors that help to predict future value of shares, share price or market developments. And so what you do is you use past data for that. So for instance, there are some studies that say, okay, you have a difference, of course, in a portfolio that's pretty straightforward. You have a difference in a portfolio that is maybe consists of those that made more money last year compared to the portfolio that loses, that it lost. Of course, it helps to predict the future development as well. There might be some past winners that now will be used to losers in the future, but it's pretty solid still. And the same there, there were some indicators that have been analyzed rather independently that help to predict, the success of the company. And then, of course, you try to combine that in multivariate models to increase the validity of your prediction. And there's a 1-factor model, as I showed, there's a 2-factor, 3-factor, 5, probably now there is a 6-factor model or whatever that you get some better percentage as well, you know, in prediction rates. But it's all based on past data. And of course, this is an issue as well again, you know. You discuss sustainability and climate change that will change in the future. How much can we rely on past data? Now, insurance companies have big problems with that now. So if you are an agriculture insurer, for instance, you have data of the past, and now you have more frequent extreme weather events, you can't use that data anymore. And they have real problems to predict, you know, then the rates that you have to pay because they don't know what might happen in the future.
Is those variation based on low frequency data or high frequency?
It's no, it's using more and more high frequency data. I think the first models that were developed in the 1950s probably are based on 100 companies or something like that. So, but now we have more, you know, in the meantime, we have better data in that. And this, especially these financial models now, yeah, they have super high frequency stuff. You know, that's,
Because all the models that are based on very fine data.
right. But it's still past, you know.
It's still the past, but I tend to predict, I mean, if it's good chart, in a new couple of days or.
Yeah, it might be that you can do it, yeah. Again, the question is, you know, if you're an insurer, for instance, or if you have a loan for 10 years, or you have an investment that you want to have for 10 years, whether high frequency past data helps you to predict that result in 10 years.
No, because I just didn't have like this question.
Sorry, I just want to be mindful of time. I know we started a little bit behind schedule. I don't want you to run out of time. And I know that we've got that for a while.
Sorry, I also don't want to slow us down too much, but you mentioned the banks and using these models, but also, you know, I know in the corporate world, Shell was one of the leaders in terms of thinking about climate scenarios. And, you know, when we're looking at carbon stabilization scenarios, we're often using CGE models that don't have business cycles at all, but there are versions that do include them. And I think banks are also thinking about these risks. Do you see any opportunity or any spaces where, you know, these other methods that have strength in the systematic risks are actually talking to these methods that have strengths with the more near term?
Yeah, I get to that later.
Okay.
Especially related to climate.
Okay.
Yeah. So it's positive. You know, it's going in the right direction, I think so. Yeah. Yeah, so again, the problem is we don't really integrate the systematic risk, and we mainly, but of course, we are based on past data in this case. And, you know, can we change that? I don't know. If you have ideas, you know, we want to discuss later. It's always great, you know, if we have different types of, you know, if we can use different type of data or models, that would be great to come up with something. You know, so going ahead, and I can keep that a bit shorter. So then later on, there were even voluntary codes of conduct. So they realized there are more risks and we have to address sustainability problems. And so they came up with kind of voluntary associations. So as I said, there's the United Nations Environmental Program financial initiatives that are coming up mainly with credit approaches and insurance and companies. Then we have institutional investors that were concerned as well, because, you know, institutional investors are mostly pension funds. And they are long-term, you know, and pension funds have a lot of direct investments as well. So they invest in forest or in agricultural land. And so, and they have to be able to pay out your pension 30 years, depending on, so they have very long-term investments. And of course, they realize, especially climate change might have an impact on that. Or you have something that is of value now, but in 30 years, you don't know, maybe it's too dry or, you know, whatever. And so, these were reasons why they try to address these things. What you see here, it's interestingly, a lot of these initiatives are very risk focused. Now, the financial industry wants to know, or the corporations as well, how are we affected by climate change, by society changes, by the water scarcity and whatever? What is the impact on us? What we see then coming a bit later is the question, how can we actively have a positive impact on these issues? And so it started in a way with microfinance. Muhammad Yunus of Grameen Bank, he got the Nobel Peace Prize in 2006 for this approach of micro-lending. So giving, lending money to poor people that they can start a business and make their living. So, and there's criticism of that as well, but it's a kind of an approach that tries to address a problem, of poverty. Before, the approach was for a financial institution, how are we affected by poverty? What happens, if there's poverty in the country, what happens for our business? But now there was a change in figuring out, okay, what can we do to solve problems? And that was relevant. So microfinance, small money, Equator, for instance, big projects, but there as well, the question was not, what is the effect of a hydro dam, of a big power plant and so forth. And so there was a bit of a change to address, to figure out how can we influence these issues, how can the financial influence that. And so it went to, microfinance, social banking. So there are some banks that say the only business we do is business that has a positive impact on society and the environment. So there's some example of that. Canada, probably the best known is Van City Savings in Vancouver. So if you can Google them, you can see what they do. So all their investments, mortgages, everything they do addresses certain societal issues, and they helped a lot in Vancouver to change neighborhoods that were kind of the risk before through their investment. So there's this field of banking, and then impact investing. So banking is more or less loans. Impact investing is other types of investment. And if you're interested there, so in Kitchener, there's Serona. That's an impact investor. As well, you can Google them, what they do. They do a lot of investment in developing countries and to address sustainability issues there. And there's a whole network, the GIIN, that consists of all these different impact investors. So it's just to show, okay, there's a certain change in the financial industry as well, though they are relatively small still. Again, the question is, if we do that, how do we calculate the impact? How do we know that a company like Serona or Van City really has an impact on certain issues? If you are an impact investor and you're focusing on climate-related projects, how do you know what did you change? And for instance, what is the change per dollar? So if you invest $1,000, how much are you able to mitigate climate change? And there might be different options. The $1,000 in that project is different than $1,000 in other projects. And again, so a link between climate models, this might be even local climate models and kind of investments type, that is probably interesting. And it's same for poverty. Microfinance wanted to alleviate poverty. Are they really able to do it? To figure out what are the connections between microfinance investments or microfinance loans and poverty rates in countries, for instance. And how can we connect these two? Can we connect both? So again, so see, these were the first example of having a positive impact. And then another one is green bonds. So green bonds are issued to raise finance for environmental solutions, climate change adaptation, mitigation, infrastructure, renewable energy. So these are fixed income products. So you say more or less, I issue a bond of 1 million, you can invest and I pay you 5% fixed rate. So that's what a bond does. And this is a conventional bond. And then companies, for instance, if they said, okay, I want to invest to reduce my energy use, for instance. Then they say, okay, I use a bond for that, and I can call it the green bond because it has no effect on the environment. And then there are ways to audit these bonds and to verify and so forth. But these types of products are pretty attractive for many institutional investors because they say, yeah, it reduces our exposure to climate change maybe. And often these bonds, are performing well because these products make sense. So this is pretty successful. We have less issuances than demand usually for these bonds. Everybody wants to buy them because the nice thing is that they have the same interest rate than a conventional bond, because the interest rate of a bond is based on the risk of the issuer. So let's say if the province of Ontario issues a bond for any type of investment, it's I don't know the exact rate, but it's 2% no matter what the bond does. So if they invested in the green, use it to increase public transport, for instance, it's 2%. If they use it for something different, it's also 2%. And in a way, for the same return, you can buy additional green return in a way, if you buy one of these bonds. So they are pretty successful. Issuers, World Bank, government banks, private banks, companies as well. So we have a 2 trillion list until in 22. So it's increasing. It's not super big compared to the total amount of bonds in the world, but it's significant. Again, how can we calculate the impact? Oh, I don't know, but that's, I don't know, hundreds of trillions or whatever. It's probably the green bonds, maybe 1 or 2% of all bonds. It's still small, but it's, it was nothing more or less 5 years ago. So it went up quite a lot. Again, what is the impact of that? If the province of Ontario issues a green bond and says we do something on public transport with that money, what is the impact? How can you calculate the kind of the green return of that? Oh, it's tricky. It's not trivial, but this might be interesting products to come up with models there. So now I can come to the climate question that you have on the scenarios there. So there was in 2016, there was a Financial Stability Board task force on climate-related disclosure. So it was mainly instigated by Mark Carney, who was the governor of the Bank of England at the time. And their approach is that they said climate change has an influence on financial sector stability. We have changes in more extreme weather, other things that influences the financial industry as well. And so they said we have to deal with that. It's a risk, so we have to come up with something. So there might be physical risks, and you see, there might be, I don't know, in Toronto, there's a lot of the IT infrastructure of the bank, probably in any basements or whatever. I don't know if the lake overflows or whether they are safe enough. So there might be physical risks that they have to deal with. Probably they're addressed, but there's something that might happen there. And also to their clients. So if you have a client at the coastline, for instance, or you have a client, agriculture, for instance, that have droughts or have floods or whatever, you might be affected there. So direct physical risk. The next problem is transitional risk. So if we want to reduce the emissions, let's say in Canada, we have to figure out how can we transition to a low carbon economy. And that means that some sectors will benefit and others won't. Now we have the big question now, what do we do with the fossil fuel industry? And if you have a lot of loans and investment in the fossil fuel industry, and it will change in the future, that might be risky for you. There might be stranded assets and you might lose money. Other fields as well, if you have, let's say, concrete production, there might be some that do it in a way that uses less energy and produces less emissions than others. So there's a transition and there's always a risk if you are an investor or lender that you might be on the positive side or on the negative side. And then the last one is stranded assets. I mentioned that. So what happens if you invest in something that is not needed anymore in the future? That how many, we can, what is it, we can burn 20% of the resources, the known resources to stay into the 2% for the next 30 years. So it's 20% of all the fossil fuel resources. Imagine how much value of companies is based on future fossil fuel resources. So if you look at the balance sheet of a Suncor or something, a lot of the value is based on potential or known future oil and gas fields. But if we say we can't burn that, that's stranded. So it's an overvalue. And so this is a risk, if you're invested. And that's not only fossil fuels, it might be others as well. There might be forestry or might be agricultural land that is stranded because in the future there's no water anymore. So these are issues that they have to deal with. And this is why they started that. And they are the ones that said we need scenarios. So they say all the financial institutions should develop climate scenarios or use climate scenarios and develop a strategy how they can deal with that. So that's relatively new. And so I hope, coming back to the question, that there will be more of that in the future. But if you talk to people in the business, they are all kind of uncomfortable with that. I say, scenario, how can we explain that? How can we explain to a shareholder that we now think this scenario will happen? And that's our investment strategy, and it's compared to the 3-factor model. It says factor 1, 2, 3. So that's what we do. That's the basis. That's much easier to to explain. It's safer. It might be wrong, but it's just easier. And coming and saying, you're using a scenario for the next 50 years or 100 years, climate scenarios, and then base our business strategy on that. If it goes wrong, then you have a problem. So that's the issue. So there's more of that, but it's still a lot of uncertainty in the industry.
Just with that 2016 recommendation paper, so a go-to document.
Yeah, no, they have more. Yeah, so that's the starting point in a way. That is that describes the general concept. In the meantime, we have the development of certain indicators. They have a guideline of how to develop scenarios. So probably 20 more reports that are going more into detail and report about what's going on in the industry and so far. Yeah. So no, I'm really there.
Great.
So what else? What we see, that so some say we need to divest from certain industries to be able to achieve the climate goals, because they are the ones that kind of emit and have the power and don't really change. And so we have seen that, and so some institutional investors do it as well. I think the Norwegian pension fund did it. There's a lot of discussion in different universities whether you should divest the endowments and the pension funds as well. And so that's an approach that is used. Of course, it's discussed very controversially whether it makes sense to step out of an investment, because many say then you don't have any impact anymore. As a shareholder, you have a certain impact of a company. If you're not invested, you don't have that impact. So that's the counter argument. The argument in favor of it is that you see we were shareholders over decades and nothing happened, more or less, in the industry. So this is another approach to address climate change. From a regulatory point of view, the green credit policy. So China was one of the first that did it, and so they said a bank needs to put more money into green industries. And the central bank has indicators to check whether they really do that. And the risk of a bank is connected to that. And if you are a bank with higher risk, if the central bank classifies you as higher risk, you pay more interest for money that you lend from the central bank. And you want to avoid that. And so what they did more or less, they said, if you if you invest and lend more to green companies, you get a lower risk indicator, and so get cheaper money. Yeah. So that's China. European Union has some regulations in the meantime as well. The US, they start thinking about it. Canada as well. So North America is a bit behind on that, but there are more and more countries addressing that, and where the financial regulator especially has analyzes that. Again, what are the indicators that we use? So if you show Bank of Canada good indicators that really shows, okay, based on our climate knowledge, we can develop something that helps you to identify the risk for the financial industry, that would be great. But they give you a lot of money for that.
Well, I understand that, but there's a problem that compared to that, impact of this kind of indicator on short-term indicators are going to be much different. For example, I feel like the Americans, the Russians, even the Saudis want war, so they can raise their asset value, which is mostly in part of industry. So those are not going to be, really helping if you look at the short-term impact on this and how financial policies change and so on. And of course, until the people in each of these countries get tired of it, these wars go on. They're all meaningless wars.
Right. One main argument, of the Canadian banks, when they were asked, what is your exposure to climate-related risk because you are invested in fossil fuel industry, they say it's all 5-year contracts. After 5 years, we can't leave the loan. They can't really, but that's the argument. You cannot say I was a lender for Suncor for 20 years and in 5 years I stepped in. That doesn't really work like that. But that was the main argument. But again, how can mathematical models help to address the question of short term versus long term? How will we address this issue? Would be great research project.
I mean, technically, it's possible to price risk in systemic risks pretty directly, just like we talked about pricing carbon. Have you seen a discussion around?
Yeah, they're kind of what banks do in the meantime is they do shadow pricing for carbon emissions, for instance, for carbon costs. But they don't talk about it a lot officially because they want to avoid any legal issues that problems as well. But you can, yeah. So they assume to. So let's say if you analyze the risk of a certain company, the credit risk, one part of it, so the model, the regression model, one part of it is of course its costs. The high costs compared to their returns, not that good. You want to have them lower. So if we say you have a carbon price in 2030 of $170 per ton for the supply in Canada, the emissions, and maybe you can predict the detailed emissions. Then of course that makes sense to account for that. And we did some modeling in that. Yeah. Right. Yeah. So we tried to do that with a very simple model, but of course there are more complex approaches to see, what are these costs doing for the company. I can skip that. Net zero, maybe at the end, is a big question. Everybody wants to become net zero. Also, the financial industry wants to become net zero. First thing, what does that mean? As climate research, what does it really mean? Does it mean you can do whatever you want and buy carbon credits, or what does it mean? How can you get there, and what are strategies that are safe, in a way? So based on data. So that's an interesting question, and I can leave that, and I can share the slides if you want to. And so I don't know if we have 2 minutes for question or comments. I'm happy to respond.
Actually, thanks for bringing it tight on time. We've had a lot of great discussion during the talk. Perhaps I could say, perhaps we can save any questions for over the break. I know we only have about 10 minutes before our next talk.
I don't want to keep anybody from your
You don't want to.
I'll get you the one shot prize. Don't worry.
Okay.
1 minute.
Okay. Sure. And then just I guess the next.
Yeah, so then it sounds like, and so thank you for being flexible, that, if are there any questions in the room? Yeah, we've got.
And then if Olaf, if you could just repeat the questions, because I think Zoom is having hard.
Okay.
I was just wondering about the macroeconomic models, in terms of increasing GDP every year, and sort of that implies an infinite growth, where we live in a finite planet. Is that a fundamental disconnect between sustainability and economic?
Yeah. So macroeconomic models and GDP, just to repeat. Yeah. So there is a research stream that tries to figure out, for instance, how can we have economic development without growth, for instance. And of course, GDP is a measure that it doesn't ignore climate change, but there might be issues even, if you have a storm and more frequent weather, extreme weather events that cost money and you need to repair all that stuff, that increases GDP at the end. And of course, from a climate perspective, from a sustainability perspective, we don't want to have that. And so there's some research on figuring out, how can we have an economy that is not dependent on growth and what are different indicators that can be used. So there's a nice book by Tim Jackson. He's an English academic and doing, I think it's called Economy Without Growth or something like that. So working on that. Peter Victor at University of Toronto did a lot on that stuff as well. So, and there are some indicators in development that are used in certain, in some US states as well, and in certain countries, that are, but there isn't a problem with that. Yeah, so the conventional growth approach in economic development is not really compatible with sustainable development. And that's a big issue in the sustainable development goals, for instance, because one goal focuses on, they explicitly say economic growth. And the question is, how does that fit into the other 17 goals? And this is a big discussion. Yeah, prosperity without growth. Yeah, right.
This will be our, I thought one hand over here, is there anything?
Yeah.
We'll take these last two questions.
I was gonna say, I'm interested in the divestment thesis, because when you divest from a company, it doesn't actually affect the company. It affects the partial ownership of the company. So the company itself, like if we were to take the oil companies of Canada, if I were to sell my shares in it, the company doesn't see that money. It's only a transfer of ownership. So how it might affect the price of the stock, but only temporarily. So how does this affect of, all of, a whole bunch of countries completely divesting from the industry? I think will have absolutely no effect on the industry.
There's a lot of research that says if you have a certain amount of market reaction, so say you have a certain number of people divesting, that it has an effect on the equity of a company, and then automatically this has an effect on the credit rating, and it increases the price of capital for the country. So there are pretty good models that show there is an effect. So of course it's traded, it's not, but we see that if there's enough of it, then you have an effect. And there's just a recent study on coal that shows that, divestment from coal power plants has a huge effect. So finally, so that's this is, but of course, that's research in progress. So there's no final thing. Interesting, I think you often hear these arguments by people that are against divestment. They never would argue like that in other cases. If you would say there's a company that doesn't behave, doesn't have good performance, of course everybody divests, and of course does it have an effect on the company. So yes, we know that it has, but interestingly with divestment, this question often comes up, but mainly it's of course because we need a really market push, a bigger push into that direction that we have a real effect.
Divestment actually reduces the stock price significantly in some cases. Yeah, for example, the value that could become a penny stock. So it does have effect.
It can have. But it often was short term and then went up again. So we need to do some. That was the last one.
I was just wondering to what extent do you think like a transition to sustainable finance would take place without the support of the government or central bank of a country? Is that something that would happen even if the government doesn't care what's going on?
Partly it happens because there are the risks that they have to address. If you see now, and environment is a big thing, of course. Another very interesting thing is the S part, so ESG. You have the social part of that became much more important since COVID, because especially in the US, we had this phenomenon that employees just ran away. They just, so a company that has a better social performance gets better employees and can finally continue doing their business. And so in the meantime, the social part of ESG is increasingly important. So there is a part that will be addressed. What I think we need more government impact, whatever, it might be regulations, but what I think as well is incentives. If we in Canada, if we don't see any big investment of the government into climate related issues, there's nothing. So why do we ask RBC to do it? Well, it's kind of there. Of course, they say the government is not really doing it, so why should we do it? And I think in Europe, there are some models that you have public banks that have certain funding and that they go into something and that they have to collaborate with private banks. And I think something like that would be really helpful, especially in Canada, because it creates kind of trust and confidence in things.
Thank you so much. Something that I really enjoyed about this talk, right, in this arc of the workshop. We heard from day one, this question of how maybe the climate problem is a governance problem. And also that we shouldn't just be focused on outcome, we also have to look at the processes that get us there. And your talk was very helpful for understanding when we also had a talk yesterday referring to like social learning, this is part of how we solve the problem. But when you've got certain ways that an industry is used to thinking about making good decisions, and that's like fundamentally challenging that. Thank you so much for giving us the detail for better understanding why it's we have to continue to work in the finance sector to try to stem climate change. So thank you, Olaf. We have a thank you gift for you.